Audio test, testing the audio, doing an audio check. Audio check, testing the audio. To me, the screen feels too, feel like the color overall is a little better, but the screen seems really faded. So for my tech team, is it better for me to be in a cave or to have a non-faded screen? Kind of changes when I move too, it looks like. Screen looks good like this. Nobody needs to see me. What do they care? That does not help. Okay, we can take votes. What do people like? Do they like a little darker with the screen? Let me click through some slides. You know, that's not too bad. Or my face? Which one's more important? See, we got a few people on now. Probably have more here pretty quick. So you early arrivers, you get to vote for what you like. Do you want the, so I can switch it here so you can see. We can focus on the screen, and I might be a little bit in a cave, okay, but the value is that as we go through, nice vibrant screen. Or we can focus on me. And we're not going to do that. That's bad. Okay, we're going to focus on the screen, but we're going to change the exposure to manual. We're just going to increase the exposure so that I'm not quite so dark, not in a cave anymore maybe, a little closer to non-cave-like, but the screen's not quite as vibrant. Pretty good, but not as good. What do we think? Kitty's just saying it looks good. Thanks, Kitty. Appreciate that. Do you have an opinion? You got one that you like better? I think I'm kind of partial to not being in a cave, but if you guys don't care, then maybe I shouldn't either. Anyone else have an opinion about it? My tech team says this is better. So maybe we'll go with this setting. The longer it sits here, the more I don't notice. But Mr. Einstein retirement man is looking a little faded. That's okay. All right, Debbie, thanks. Debbie says we look good the way we are. If I mess with it, it'll probably get worse, and then I won't be able to get it back to where it is. So maybe we just leave it alone. Thanks, Debbie. Al wants me out of the cave. Hi, Al. It's good to see you again. I remember you from last week, I believe. Maybe even the week before. I can't remember. But glad to have you. Al prefers me out of the cave. You might be a little biased, Al, because you've seen the presentation before, so maybe you don't need as good a look at the slides. I do tell some jokes that I don't know how they sound in a cave, but yeah, we're starting at 7. That's right, Donnie. Yep, right at 7, about 9 minutes out. As you can see, I'm in a different location. My family's doing some traveling, and so we're enjoying the Upper Peninsula of Michigan and having a good time up here. And so I'm doing a presentation from at the house that we're staying at. So a little bit different setup. Thanks, Ron. Appreciate that. Good. Glad it's looking good. Okay, I know that Facebookers can hear me because you're typing in, and I appreciate that. Anybody on YouTube, are you able to hear me? Just making sure. I see that we have some folks on YouTube, but I want to make sure that you can hear me and we're good there. Everything okay on YouTube? Okay, great. Thank you, YouTube. Appreciate that. Thanks, Jennifer. Art, thank you. Jan, you were the first. Thank you for that. Appreciate that. Oh, Al was the week before. Okay, all right. Well, can't keep track of you, Al. Oh, okay. All right, good, Al. Yeah, we intend to do the tax workshop again. We've kind of taken a little hiatus from doing it. We find that it's kind of best in some cycles. And so right now we have sort of put that on hold, but we do intend to do another tax presentation again. If you aren't familiar with our daily podcast that we do, I'd encourage you to check that out. Again, we're going to start in about 6 minutes, but our daily podcast, I encourage you to check that out. I did an interview earlier today, actually, with Dr. Robert Pokorski, or Dr. Bob as he's called by many folks. And he has been lecturing and talking about retirement, the combination of retirement and health topics, and how that affects us both from a health perspective as well as a financial perspective. I really enjoyed doing that interview with him. He had written an article in the Journal of Financial Planning, which we are avid readers of, and his article was really quite good. A lot of really big takeaways and key highlights, really revealing stuff in the realm of planning for long-term care. I know it's everyone's favorite topic. It's something we cover our eyes, hold our nose, try not to breathe too hard, and hope it doesn't happen to us. But the reality is, unfortunately, many folks have to deal with some type of long-term care. And so if you're ready to start thinking about that topic, I would encourage you to check out that interview. Again, we did it earlier today, so it should be pretty easy to find either in our YouTube channel or on our Facebook page. You should be able to see that. Thank you, Scott. Glad you're here. Mike, thank you. All right, again, we're going to get started here in just about 5 minutes. We're about 5 minutes away. Al lets us know that he's a watcher of the podcast. Great, Al. That's good to hear. Yeah, the podcast today was really good. I like that. Dr. Pokorski did a great job. He's really one to listen to. And if you have a LinkedIn, I'd encourage you to try to connect with him on LinkedIn. And he posts a lot of his articles and publications there as well, and you can follow his stuff. Really good for an aging population. Not that any of you are aging, of course, but it's just really good stuff. Really does a nice job of combining that focus on physical health as well as financial health simultaneously. Hi, Diane. Okay, glad to have you. Diane's a first-timer. Any other first-timers? Again, we're going to start in about 3 minutes here, right at the top of the hour. Okay, see that we have people continuing to come in. Okay, a lot of first-time viewers. Great, glad to have you. Maybe a little preemptive, but if you do like today's presentation, I'd encourage you to subscribe to our YouTube channel or follow our Facebook page, one or the other, or both. And that would allow you to, of course, see additional content when we do other workshops like our tax workshop. We are, as I mentioned earlier, we did a podcast earlier today, an interview with Dr. Robert Pokorski, who's a medical doctor and a master of business. And so he does a nice job of combining health care needs with financial needs and how those two things coordinate together as we age. And so I encourage you to check that out, and you'd be able to see that content also and similar content by subscribing. And also, if you are so inclined, you can find me on Twitter, and that is at Kyle J. McCauley 1. If you are a Twitterer, never been too much of a Twitterer, but I've gotten a little more acclimated to it of late. And so you can also find me on LinkedIn as well. LinkedIn, I don't remember, you just look up Kyle McCauley in the Detroit area and I should pop up. But it's Kyle J. McCauley 1 because Kyle J. McCauley with no one beat me to it. He's a hockey player. So if you like hockey, you can connect with him also. But happy to interact with you at future events and future workshops and all of that. Okay, we're going to get started here in about a minute, so don't go anywhere. Get your cup of water or cup of tea or coffee or whatever you like. Leslie's saying, first time here, I did not receive my workbook. Yeah, that's right. We'll talk about how to request the workbook at the end of the presentation. So no problem, Leslie. Hang tight. We will absolutely get to that and talk about how you can get that workbook. Okay. Okay, my tech team is asking me to do something here. Okay, we're good. About ready to get rolling. Okay, just a quick confirmation from my text team. All the reminder texts went out. Just want to make sure before we get started, make sure everybody has an opportunity to join in before I get going. Okay, we're checking on the messages. Glad you're all here. Did you all join in from the email or was it the text message? Did anyone here join in because of the text message? Tech team's checking on the text, making sure that all of them went out. Again, we're going to get started here in just 1 second, so hang tight. Okay, looks like we had a big group just join in, so I'm thinking some of the texts just were received. Okay, most of you are email. We've got a couple of people who got the text. I'm thinking the text messages are just now hitting. Yeah, most of you are email. Okay. No problem at all. If you give us just 1 second, we do want to give the text message a chance to go out. Okay, we're not going to make you wait too long, but it does appear that we do have some texts that have yet to go out yet. So we're going to be looking for that. I see some of you are just now getting the text messages, so it probably means there's a trail end of people who are just now getting them. Sorry for the little bit of delay, but technology. We love it, and we hate it, and we love to hate it, and if you're like my dad, you might yell at your computer. We love to yell at our technology as if it can hear and understand us. My dad says it makes him feel better, so that's good. Okay, we're going to get started here. I don't see confirmation from my tech team, but we're going to get started anyway. I hate to have people waiting when you were here on time. So Let's go ahead and get rolling. People will join in as they get their messages, and I'm sure we'll be just fine there. So with that, welcome to a presentation here at Einstein Retirement Workshops. Einstein Retirement Workshops is a national organization, and we provide workshops all across the country. We used to do the bulk of them, really all of them, face-to-face, where we would see you at a community center or a library or university, something like that. But now with the advent of COVID and everything that we've had to deal with there with travel restrictions and gathering restrictions and all of that, we've been very happy to continue to offer these workshops in this live stream format. So we're honored that you're here and we're glad to be able to do that. One of the nice things about being able to do this is that I'm actually not in my home office in Troy, Michigan. I'm up in the Upper Peninsula right now, and so the house that we're staying at, we selected very specifically so I could still do this presentation for you. So for those of you, I know I saw a couple of you who've been here before. For those of you who are here for the first time, this is not the normal view, but it's just fine. Normally we have a little bit better lighting. I don't get quite as shadowed. And the TV, this is one of the old plasmas. It's not hot yet, but I'm sure that by the end of the presentation, I'll be getting some heat. So I'll stay nice and toasty warm. All right, format for today's presentation. What we're going to do is we're going to spend a little more than an hour on the topic of Social Security. At the end of that hour, we're going to do two things. The first one is we're going to talk about how you can get access to your Social Security filing workbook. I've already seen a few of you ask about it, and we want you to know that workbook will be made available to you. At the end of the presentation, we'll talk about how you can request it. It is a physical workbook. We are going to mail you a copy, so do hang tight. We'll talk about how you can go and request that workbook. We'll be happy to mail it to you. Now, secondly, at the end of the presentation, we will go into a Q&A portion of our time. So for those of you who were here and saw me do it, I was able to tap on your comments and I can put them on the screen. I will do that during the Q&A portion where I will tap on your questions and then I'll answer those questions. So we tend to get comments throughout the presentation, so I do encourage you. You can put your question in whenever you would like, but to make sure that I answer it, just put it in right at the end of the presentation when we get started on the Q&A, and I'll do my best to answer just as many questions as I can. Okay, my name's MCCauley. I'm one of the national presenters here at, I realize that's not up here. Let's put that up there. National presenters here at Einstein Retirement Workshops. And in addition to that, I want to share with you about my background so that you have a good sense as to what my focus is and how I think about this presentation as I'm giving it. So I'm a managing partner of City Center Financial, which is a retirement planning firm. I'm also a chartered retirement planning counselor, an accredited portfolio management advisor, and then also a national Social Security advisor certified professional. So as the managing partner of a retirement planning firm, I think you can imagine that when I'm doing this presentation, I'm thinking about many other folks just like you who are also having things to deal with in making this Social Security filing decision. So we've helped our clients and many, now hundreds of folks, make good, high quality Social Security filing decisions. And so when I talk about the case studies and the various topics that we're going to discuss, I'm often thinking about other clients, just like, very similar circumstance to yourselves that have had to think through these various things. We are not affiliated with, nor are we employed by the Social Security Administration. That's good because we can give you advice. And technically they're not supposed to. Now they may say things that sound like advice, but you need to be aware that technically speaking, Social Security is not supposed to give you advice. Sometimes when they say things to you that sort of sound like they're giving you advice, sometimes that is proving why they're not supposed to be giving advice. but sometimes it's okay. Sometimes what they say is just fine. So just be aware of that. Also, we are able to give advice about Social Security and how that fits within the context of your retirement planning decisions because of our registered investment advisory firm, City Center Advisors. Why is Social Security such a hot topic? Why are all of you here? Well, every day, 10,000 baby boomers turn 65. Also, that will turn into 70,000 per week, 280,000 per month, and 3.64 million per year, and that's expected to continue for another 13 years. We highlight the age 65 because that starts qualifying people for benefits that they were used to paying for out of their FICA taxes. So Medicare and Social Security can be filed at this age. 62 for Social Security, obviously, as early as, but Medicare at 65. And so what that means is that we got a lot of people who are qualifying for benefits who were used to working and paying taxes into this system through those FICA taxes. So brings up issues or concerns. Hey, what about sustainability of this program? Is there going to be something available for me when it's my turn to file? That's a lot of people that used to pay taxes. Now they're drying out. Should I be concerned? And we'll certainly touch on that. 65% of middle-income Americans derive more than 50% of their retirement income from Social Security. Now that's true, obviously, for those who haven't done maybe a great job of saving other forms of retirement income, but it's also true for those who have. And the reason is the benefits are still here, and in many cases they can be quite good. It is not uncommon for us to see a married couple with $40,000, $50,000, $60,000, $70,000 or more a year in combined Social Security benefits once they both have triggered them. So that can sustain a lot of people and in many cases can cover more than half of their total retirement income need. I think if we were in a room together, I've done this live enough to know that if I asked for a show of hands, who's been told don't plan on a Social Security check, we would probably see all of your hands or close to all of your hands go up. And the reason for that is that this system has been a topic of conversation both at the dinner table and politically for a long time. And the biggest concern is it seems maybe like something that's not sustainable. And so part of that fear about am I going to collect anything has caused some people to maybe not do the proper level of planning to maximize what they get out of the system. So, I'm probably preaching to the choir because you're here, but it is worth doing planning to get what you're owed out of this system because you've paid for these benefits, you're absolutely entitled to them, and it's worth maximizing what you get. Now, since 1985, pensions have really been evaporating rapidly. More than 84,000 pensions are gone. We also see pensions being frozen. We see them reduced after they've started. We've seen pensions where they have been, did I say frozen already? I think I already said that. Okay, frozen or even reduced after they started. So what that does is that highlights the importance of Social Security because these are both income streams that are guaranteed by a third party to continue to pay to you. So Social Security has become a really big backbone of most folks' retirement plans. Now, 46% of Americans today pass away with less than $10,000 to their name. And that statistic is here because we want to, of course, highlight one of the key features of Social Security. You see, you insure all the important financial things in your life. Do you insure your house? Yeah, of course. What about your car? Yeah. Your health? Absolutely. Do you insure your retirement? The answer is yes, okay? If you have a Social Security benefit, then you have a form of retirement income insurance, or we could say longevity insurance. You see, even that person that's passing away with less than $10,000 to their name, so long as they are still living, they are still receiving those Social Security checks. So if you want to frame in your Social Security benefit properly, you want to think about how does that fit into your retirement plan. Social Security is a form of retirement income insurance, or again, we could say longevity insurance. Why longevity insurance? People are living a lot longer than they ever expected to. A married couple, age 65, gentlemen, you have a 50% chance of making it to 92. Ladies, you have a 50% chance of making it to 97. My granddaddy's a great example of this. He never expected to live to 92, but that's actually the age he lived to. Passed away last year in December, not COVID, just old age, good old-fashioned way. And we never would have thought he'd live to 92. He had 4 heart attacks and 3 bypass surgeries by the age of 75. If you'd asked him at 76, hey, Granddaddy, you think you make it to your 90s? He just smiled and said, I don't think so. But he did. Medical technology, frankly, my granny, was a good result for him in terms of living much longer than expected, able to meet and see and get to know his great-grandchildren, and so pretty impactful, pretty remarkable for him to make it that long. And many other folks are going to live again much longer than they expect to. There again, when you file Social Security, it's important to think about not just, oh, how long do I think I'll live, or what's the average? It's really important to consider the possibility that you may live much longer than you're expecting to when you make the Social Security filing decision. Kane Tanaka, currently the oldest living person, at age 118, is the oldest living person from Japan. Interestingly, of the last 5 oldest living people, 4 of them were also from Japan. So if you really want to boost up your life expectancy and you're thinking about relocating, I might recommend that you go to Japan. We'll see if she makes it to 119. She turns 119 in January, so we're over halfway there. She's over the halfway mark to 119. We'll see if she makes it. Our focus for today, basics about how your benefit is calculated and how that works. Strategies for those of you who are married, options for those of you who are divorced. Also talk about options for those who are widowed. And if you fall asleep somewhere in the middle, please do wake up in time for taxes. I can tell you, having run now hundreds of analyses personally, our organization has now helped thousands of folks file for benefits and make those decisions. And what I can tell you is that if there is one single item that will take 2 strategies that kind of look close, there's some benefits here, there's some benefits over here, which one, maybe a flip of the coin, and takes away that flip of the coin and says, nope, this is no good, we got to file this way, it's the issue of taxes. So I want to make sure we spend enough time on that to give you some good insight. Let's talk about some basics of how your benefit works. The way that you qualify for a Social Security benefit is by paying FICA taxes, and you pay enough FICA taxes to earn a credit. You earn up to $1,470 of earnings will earn you a credit. You can earn up to 4 credits per year, and so that will give you 40 credits to qualify for a benefit. If you can earn 4 per year, that works out to 10 years worth of work. If you are not sure if you have all 40 credits, pretty easy to find out these days. You just create a profile at ssa.gov. And when you go to ssa.gov, you can do 2 things. Let's say 3 things. We're going to talk about the third one just very briefly. The first one is you can see right there in green boxes that go across the screen and then a big green check mark at the end. If you have the big green check mark at the end, you have all 40 credits and you qualify for a benefit. The second thing you can do is you can download an up-to-date Social Security statement, which is important to do because there is a statute of limitations on checking your earnings history. And so you do want to check your earnings history every year to make sure it's correct. Occasionally there's mistakes, as I'm sure you can guess, and you'll be amazed to hear this. Rarely are the mistakes in your favor, so it is something that's worth checking every year. The third reason that I'll touch on very briefly, there's a bill that's being pushed in Congress right now that has Social Security wanting to mail out Social Security statements to everyone over the age of 20. Please sign up for the online portal and tell them not to mail you that. Social Security has enough financial troubles already. They don't need to waste money on mailing out statements when it's so easy now to have an online profile. If, of course, you are the person who likes the paper statement mailed to you, then please have them mail it to you. You will not hurt my feelings. Okay, the highest 35 years. The highest 35 years of earnings is what is used by Social Security to calculate your benefit. If you do not have all 35 years, here's how it works. Social Security will say take 25 years of earnings, let's say you only have 25, and then they'll add in 10 zeros when they calculate your benefit. So any additional work that you're doing today is replacing a zero to get you closer to the 35-year mark, and then that will do a nice job of increasing your benefit for the future when it comes time to file. Now, one thing that's important to realize is that it's the highest 35 years no matter when those years occurred. So if you worked 25 years, took 10 years off, worked another 10 years, no problem. That's still 35 years. Your benefit will use those 35 years, but it won't use those years exactly. It will use those years after those dollars have been indexed for inflation. In your Social Security filing workbook, which we're going to mail to you, there is an indexing table. So your income earned in years gone by needs to be indexed for inflation in order for you to know what those dollars earned in the past are worth in today's dollars when Social Security calculates your benefit. Let's take an example. Let's say in the year 1980 you earned $20,000. Well, $20,000 in 1980 is worth a little more than $80,000 in today's dollars. What you would see on that indexing table is that you'd plug in your $20,000 and you need to multiply it by 4 and change to equal today's valuation. So that 80, oops, sorry about that. Knocked off my mic there. And I just did it again. No, this is not a comedy show, but if you're laughing, that's fine. Okay. Feel like that's a little, what is it? I prefer the intellectual humor whenever possible. That was a little, what is it, the Three Stooges style. Okay, highest 35 years. I forgot where I was. 20,000 in 1980 is worth 80,000. If you're earning 60,000 today and that's your lowest income year in the past, you're not going to replace it. And so that's what you need to understand. Okay, so the 20,000 is worth 80,000 in today's dollars. You have to earn more than the 80,000 in today's dollars in order to replace that lower income year in the past. Okay, some people mistakenly assume that just because you're working today necessarily means that you're increasing your benefit in the future. Not necessarily. You do have to replace a lower income year in the past for your work today to increase your benefit. Now, it's not necessarily that it's decreasing your benefit, it's just it may not be increasing that benefit. Okay, the two main provisions that can reduce your Social Security benefit are the government pension offset and the windfall elimination provision. If you have what is called a non-covered pension, a non-covered pension is a pension that you earned while you were not paying taxes into the Social Security system. So, if you're not sure if you have one, you can go to page 3 of your Social Security statement, and on that page you would see all your earnings history. All that earnings history, if there's zeros when you had the job where you were earning the pension, you have a non-covered pension. So if you're one of those folks, the first provision you need to be aware of is the windfall elimination provision. That applies when it's your Social Security benefit that you also have. Okay, the calculations are in your workbook. They're a little complicated because they have to do with number of years of substantial earnings, which I do not have memorized. And so you just need to understand that the windfall elimination provision, when you claim your Social Security and also your pension, depending on how many years of substantial earnings, you'll have a reduction on your Social Security. It can't reduce it to zero. You're always going to get something, but the amount is going to be determined based on the number of years of Social Security earnings you have. The second one you need to be worried about is if you do not have your own Social Security. In that case, if you're trying to file an ex-spousal or spousal Social Security benefit, you have to deal with the government pension offset. The government pension offset applies this way. 2/3 of the pension that you're receiving, whatever that monthly amount is, count against any Social Security that you could receive. Again, this calculation is also in your workbook, but if 2/3 is more than the spousal portion, then you would not receive anything. You paid a lot of money into Social Security, 6.2% of your pay over the last 10, 20, 30, 40, however many years you've been working. Your employers match that for up to 12.4% of your pay, again, over the last 10, 20, 30, however many years you've been working. Unfortunately, the way it works is not like, say, an investment account. You don't have an account with your name on it, with your dollars in it. No, the system is a pay-as-we-go system. That means that taxes flowing into the system today are leaving the system today to pay current recipients. System is currently operating at a deficit. How do we know? Well, at one time it was not operating at a deficit and we had a surplus. With that surplus, the Social Security Trust Fund was buying U.S. Treasury bonds. That's how we've loaned money to the government. For those of you who have heard of this, they did it by buying Treasury bonds. And so when they bought those Treasury bonds, we were building up a little reserve to pay out benefits for when we got in the red. We've been in the red since 2010, and so what that means is that Social Security is now selling, the trust fund is selling Treasury bonds to pay out current benefits. We're fully funded through the year 2035. In 2035, the Treasury bonds are gone, and we're paying for it all on taxes, and the taxes are likely to not be enough. So in 2036, it's estimated that we're going to be funded roughly 75 cents on the dollar. Now, here's what that does not mean. In 2026, you should not expect your check to be cut by 25%. Why? Well, because if it was, there would be riots. Okay, yeah, I mean, that's part of it. But they'll fix it in some other way, more of an actuarial way, an accounting way, a calculation, a mathematical calculation way. So what they'll do is they'll reduce benefits for your children and grandchildren. How do we know this? Well, they did it to you, so they'll do it to your kids and grandkids. How do we know they did it to you? Well, your parents could file for their full retirement age benefit at 65. The oldest of you can file at 66. Then there's a big group of you, maybe the majority of you, that can file at full retirement age of 66 and some number of months. And then there's the youngest of you who have a full retirement age of 67. So that move from 65 to 67 in the full retirement age was a fix to the Social Security system. And so they'll do that to your kids, right? Maybe they'll take away the 62 filing completely and push it to 65. Maybe they'll change the full retirement age all the way up to 70, something like that. We don't know what they're going to do, but they have to do something because the system is underfunded. So increasing taxes, likely not the best strategy for our government for all kinds of reasons, but it is the one that gets the most pushback, although maybe it would be in some ways the most reasonable. Okay, how are benefits determined? I know I said that many of you do have a full retirement age of 66 and some number of months, but just for ease of explanation, we're going to assume for a minute that everyone has a full retirement age of 66. If you file for benefits at your full retirement age, you receive 100% of your primary insurance amount. Okay, your primary insurance amount is the amount that is estimated for you on the very front page of your Social Security statement. In the upper right corner, that big bold number is your estimated primary insurance amount. If that number said $2,000 and you file at full retirement age, you would receive $2,000, 100% of it. If you want to file early, you can. You can file as early as 62, and you'll be eligible to receive 75% of your primary insurance amount, turning that $2,000 benefit into a $1,500 benefit. If you'd like to delay past full retirement age, you can and be rewarded for it. 8% increase per year that you delay past full retirement age. These are known as delayed retirement credits. You could turn that $2,000 check into $2,640 if you delay all the way till 70. I know that know that there are three, of course I know, I'd like you to know that there are actually three distinct Social Security benefit types. Okay, those three benefit types are, number one, your own work history, the retired worker's benefit. Okay, that's the benefit that you're entitled to based upon your own work history. Second benefit is the benefit you're entitled to based upon a spouse's work history or an ex-spouse's work history. Okay, the next type of benefit is a widow or survivor benefit. These are benefits that you're entitled to based upon a deceased spouse's work history or a deceased ex-spouse's work history. Last time Social Security law was changed was October of 2015. Basically what they did is they took away all the fun stuff, with one exception, rapidly diminishing group. I'm not going to spend a lot of time on it, but if you happen to be in this group and you'd like to ask about it in the Q&A, please let me know. If you were born before January 2nd of 1954 and you've not yet filed for a Social Security benefit and you have access to a spousal or ex-spousal benefit, you can do a restricted application filing for the spousal first and then switch to your own at a later date. In order to do this, you must be born before January 2nd of 1954. For everyone else, including that group, there's just a couple of other things that you want to be mindful of when it comes to how you would file for Social Security. Number one, you are allowed to suspend your benefits at any time for any reason. What that means is you tell Social Security, you might be receiving an income, you say, wait a second, stop sending me a check. Why in the heck would you ever do that? Well, let's say, for example, you were laid off from a job, unemployed. You say, well, I guess maybe I'm retired. You file for Social Security. Then, lo and behold, a job comes back. You weren't quite ready to retire yet, so you take it. Go back to work. Now you have your employment income, you have Social Security, you don't really need the Social Security. What can you do? You could suspend benefits, tell Social Security to stop paying you, and from the point of suspension until you file again in the future, you will earn any delayed retirement credits that you're entitled to up until that point. If you are doing this within the first 365 days, you are allowed one time to do a rescinding of your application. Rescinding your application would tell Social Security not only stop paying me, but reset my benefit as though I never filed. The only catch to this is you have to pay back any dollars that have been paid to you up until that point. Okay, let's talk about spousal benefits. In order to qualify for a spousal benefit, you need to have been married for at least 1 year. Also, spousal benefits work off of what's called deemed filing. Deemed filing says that the primary worker, the person you're filing that spousal benefit from, has to have filed their benefit in order for you to get the spousal. If you have a benefit of your own that is more than 50% of your spouse's primary insurance amount, okay? My wife has $2,000. Let's say I have a benefit of $1,500. Half of her PIA, $2,000, is $1,000. My $1,200 is more than that. I am not entitled to a spousal benefit. I'm just going to be working off my own. So you have to not be entitled to more than 50% of your spouse's primary insurance amount to have access to the spousal. It's 50% of your spouse's primary insurance amount, not the benefit amount. So if John's primary insurance amount is $2,000, Jane is eligible for half of that, $1,000 at her full retirement age. Now, if John files that benefit early at 62, he's getting $1,500. But if Jane waits till her full retirement age, she will still get the full $1,000. It's not half of what John gets, it's half of John's primary insurance amount, then modified by Jane's age. So if Jane waits till her full retirement age, she still gets the full $1,000. If she files early at 62, she's not going to get half of John's. John's getting $1,500. Half of that's $750, but Jane doesn't get $750. That's 75%. She gets 70% or $700. So spousal benefits reduce on a faster schedule when filing early. If you want to think about it like extra penalties for spouses who file early, maybe that's a fair way to say it. Also, there are no delayed retirement credits for spouses when you delay a spousal benefit. If Jane waits till 70 to file her spousal, she doesn't increase that $1,000. It's still only $1,000. So there is no incentive for spouses to file early. Common example, Jane has a $500 a month benefit. John has $2,000. Jane's thinking, I want half of John's, $1,000. I don't want just my $500. Wonderful. Except deemed filing says John has to file. So if John wants to delay till 70 and max out his benefit, Jane also has to wait till 70 to collect the spousal portion. But she could start at full retirement age and start collecting $500 a month, and then when John files at 70, she'll go from $500 to the full $1,000. Okay, survivor benefits. Survivor benefits apply like this. Married couples, when one of you passes away, only one benefit remains, and it is always the higher of the two. So, my wife has $2,000 in her benefit, I have $1,000. I pass away. I take my $1,000 with me, she keeps her $2,000. My wife passes away. I say goodbye to my $1,000 and I keep her $2,000. Only one benefit remains, it's always the higher of the two. The only caveat or way to get an increase on that survivor benefit is the 82.5% rule. If my wife had filed her benefit of $2,000 at 62, she's getting $1,500. If she predeceases me, I get a bump up to 82.5%, not $1,500, but $1,650. Two most common mistakes that we see married couples making. Number one, higher wage earner files early. Why would that be a mistake? Well, remember when you frame in Social Security and you're thinking about what do these benefits mean to me in my retirement plan, the way to think about this is as longevity or retirement income insurance. These are benefits that are going to pay to you so long as you're living. If you're married, not just how long you live, but also your spouse. Let's say you happen to pass at 75, but then your spouse lives to 95. We're talking about 20 years with one Social Security check. Smaller check is gone, only the larger one remains. So generally, that higher wage earner is the person that should be doing any amount of delaying. If we make a recommendation, the recommendation for a delay is always or generally going to be on that higher wage earner, not the lower wage earner, because of those longevity needs and concerns. Okay, generally speaking, when one of you files, you're going to file early to some degree or another, and the other one might delay to some degree or another, obviously within reason, but likely that's the type of recommendation that comes back. It almost never works out for both of you to delay past full retirement age. Almost never, okay? Maybe for tax planning reasons, maybe for portfolio success reasons. We've run thousands of analyses. I can just tell you it almost never works out for both of you to delay past full retirement age. Again, one of you is likely to file early to some degree or another. One of you is likely to delay to some degree or another. Let's talk about divorced spouse benefits. In order to qualify for a divorced spouse benefit, you need to have been married for 10 years in a row to the same person. Okay, married 7 years, divorced, remarried 5 years, divorced, even to the same person. Doesn't matter, 7 plus 5 does not equal 12. One of those two stints has to be the 10 years in order for the divorced spouse benefit to qualify. I know none of you came on here for marriage counseling, but if you need a reason to hang on, there you go. You may not be currently married, okay? If you've remarried and you had a marriage that lasted more than 10 years and you're thinking, gosh, I'd like to file on those benefits, sorry, it's just not available, okay? Right? You're going to be filing off your own work history or the new spousal benefit. Same benefit amounts in terms of extra penalties for filing early and no increases for delaying apply to the ex-spousal benefits as did those regular spousal benefits. You are independently entitled to file an ex-spousal benefit so long as you've been divorced for at least 2 years. This is the big difference between ex-spousal benefits and spousal benefits. So long as you've been divorced for at least 2 years, you're able to file those ex-spousal benefits regardless of when your ex files their benefits. Again, if you're born before January 2nd of 1954 and you've not yet filed for a Social Security benefit and you have access to an ex-spousal benefit, the restricted application is a great idea. You should probably do it. Okay, one goofy thing about divorced spouse benefits. If you have a marriage that lasted more than 10 years and that person is younger than you, you hit 62, file for your benefit. A couple of years go by, that younger person hits 62 and their spousal is more than your own. You can switch and get the higher amount. If you can manage to fit another 10-year marriage like that in, and that person is 62 and theirs is higher yet again, you can switch again. As many times as you can conjure up that scenario, it is allowed. Common questions we hear from those who are divorced. I'm divorced. My ex is going to file off of my work history. Is that going to affect me in some way? No, it will not. I'm divorced. My ex is going to file off of me. I've remarried. My new spouse is filing off of me. Are their benefits going to affect each other? No, they are not. I'm divorced and I've managed to fit a few 10-year marriages in my lifetime. I'm remarried and I'm going to die young. No, just kidding. Okay. So yes, all these people can file off of your work history. The new spouse can. It's allowed. And in fact, if you do happen to die young, they can all get widow benefits. It is allowed. I'm divorced. I'm going to file off of my ex's benefit. Are they going to know that I've done that somehow? No, they will not. Remember, it doesn't affect them. There's no way for them to know. Social Security doesn't tell them. The only way they would know is if you told them. Okay, considerations for those who are widowed. Widows are a special group. They are the only group who can file at benefits at 60. In order to file benefits at 60, assuming you were widowed prior to reaching 60, you must remain unmarried until you turn the age of 60. The very first workshop I ever did, a gal in the back raised her hand during the Q&A and said, so if I understand this right, it sounds like I need to delay the wedding. Of course, everybody laughed, thought that was pretty funny. But in fact, yes, it was a good idea for her to put the wedding off. So let me kind of explain her situation. So she was planning to get married in September. This was a June workshop. She's 59 years of age. She does not turn 60 until March of the following year. If she were to file for benefits, if she were to get married in September, she cannot file for benefits next March when she turns 60. She has to wait until 62 to file either for her own benefit or the new spousal benefit. If she does not get married and files for benefits at 60, her widow benefit was worth just under $2,000 a month. Her new spousal benefit, which was the higher of the two, was just under $1,500 a month. So she has to wait 2 years to get $500 a month less. So yes, in her case, it was a good idea for her to delay the wedding. Now, I'm a religious person. I think this is funny. You can decide how you feel about it. But she went to her priest and said, so can we just, do the religious part of the ceremony and sign stuff later? And the priest said, no. I said, there's another priest. I'm sure of it. But she's very devout. She delayed the wedding. Good for her. Okay, last bullet point here. You got to be married at least 9 months prior to the death of your deceased spouse in order for widow benefits to be available. However, this is not here to hurt people. It is here to prevent deathbed marriages. Only real life example, I've run into this. Gal was married later in life. Husband was in the armed forces, shipped overseas, killed in action. They'd been married just under 6 months. It wasn't as though he had a terminal illness or some known reason why he was going to be passing. So all we had to do was submit the proper documentation, and those widow benefits were reopened. Okay, another widow case study. Widows get the most options in terms of how they can file for benefits, so we want to outline what those are, and this case study does a good job of highlighting them. John, who we never met, also did not elect his benefit, and he died at 64. His benefit at his full retirement age would have been $2,150. Jane, who's 5 years younger, she's 59 when John dies. We meet her at the age of 60. She's attending one of our workshops, and she's trying to figure out, what in the heck should I do? I hear I have this widow benefit. Should I file? What's going on? Jane does have her own work history, and she has a benefit available to her at 62 of $1,197. What are the options for Jane? Well, number one is Jane could go ahead and just file widow benefits, right? She's 60 years old. She could file. That benefit, John's a little more than $2,000, is worth $1,537 if Jane files early at age 60. If she files at 60 and then passes away at age 85, over her lifetime she would have received $461,000. But Jane has options. She doesn't have to do it like that. What else could Jane do? Well, the real Jane was still working, and because of the earnings test, which we'll talk about in just a second, she is not going to file right away. So she is going to work for 2 more years. She hits 62. She's ready to retire. Okay, she didn't want to make any big changes. John had recently passed, and so now after a couple of years, she says, okay, I'm ready to retire. She retires at 62 and files first for her own benefit, $1,197 a month. She receives that from 62 to 66. And at age 67, she has now maxed out that widow benefit. Widow benefits are maximized not at 70, but at your full retirement age. And so she switches to John's widow benefit, $2,150. Total benefits over her lifetime, $538,000, $77,000 more over her lifetime simply for understanding her options. But Jane has another option. Let's say she was ready to retire, so she doesn't have to worry about the earnings test. What is best for Jane to do in that situation? Well, what Jane should do is she should go ahead and file for widow benefits right away at 60. But her own benefit, she'll collect that from 60 to 69, but her own benefit will be available in a maximized form at age 70. So her own benefit increases, full retirement age, 8 delayed retirement credits to 70, and now it is worth $2,108 a month. Over her lifetime, total benefits, $563,000. And these are not adjusted for inflation at all, and that's $100,000 more than what she would get if she did not switch. But Jane does have to know to switch. This does not happen automatically. Social Security is not going to give her a courtesy call. She has to know to do it, so very important. Now, I'm often struck by these numbers, 400, 500,000. Non-inflation adjusted, a single person, married couples, we see over $1 million very often in lifetime estimated benefits, sometimes up over $2 million. And so, look, maybe I'm preaching again to the choir because you're here, but it is worth doing planning. For many of us, this Social Security filing decision may be one of the single biggest financial decisions that we ever make. So do take the planning seriously. Okay, you're allowed to work and file for benefits at the same time. Once you reach your full retirement age, you can work, earn any amount, and have Social Security, and it is no problem. I mean, other than taxes, right? But other than taxes, it's no problem. However, if you file for Social Security prior to reaching your full retirement age and you have earned income, there is a limit and an earnings test that will cause you to not receive some of your Social Security. Here's how it works. The first $18,960 of earned income being W-2, 1099, or self-employment, earned income that you have does not count. They don't care about it. Social Security says, fine, have your $18,960. What do we care? But the minute you go above the $18,960, Social Security starts caring. They care about $1 for every 2 above the limit. So let's say you have an income of $58,960. Odd number, but makes the math easy and you'll see that. $58,960, the first $18,960, Social Security doesn't care. So we take that off the top, it leaves us with $40,000 above the limit. It's a 1 for 2, so we chop it in half. That means we are ineligible to receive $20,000 of our Social Security. Let's say the benefit you're applying for is a $2,000 a month benefit. $2,000 goes into $20,000 10 times, meaning you will not receive a benefit in January, February, March, April, May, June, July, August, September, October. Then you receive a $2,000 check in November and a $2,000 check in December. Some people do mistakes. As my father would say, grief is never good. But we thank Charlie Brown for that wonderful. Is there someplace I can put this where I'm not going to hit it? I don't know. We'll see. Thank you, Charlie Brown, for good grief. Okay. I forget where I was. Some people mistakenly assume that if they go above the limit, they simply get a reduced amount, but they still receive a benefit all year. Not so. Social Security will simply not pay you anything until you have paid back what you were ineligible to receive. Okay, the right side of this page almost never applies to anyone, but if you're in the year that you turn your full retirement age and you'd like to file for benefits before reaching your full retirement age, your earnings test is $50,520 and it's a 1 for 3 limit. But you have to hit the $50,000 before you turn your full retirement age. If your birthday's in March, probably no big deal. If your birthday's in November, maybe you have to deal with it. Okay, taxes. Taxes is unfortunately a little complicated. We know this very easily because we can pull up publication 915. This is page 1 of that publication, and we can see that this is a 33-page document. Why does it take 33 pages for Social Security to tell you everything that you could possibly want to know about how you'll pay taxes on Social Security? Because just like about everything with taxes, they can't do it simply, they do it complicatedly. Publication 915 is that document if you want to look it up. There are some helpful things in publication 915, maybe a little tongue-in-cheek, but it was helpful to me, okay? So but there are worksheets, okay? This worksheet is in this publication, and this worksheet will detail out for you the 19-step process that you must go through to determine how much tax you're going to owe on your Social Security benefits. Now, what we are not going to do is cover all 19 steps, so don't worry if you're worried about that. Put your mind at ease, okay? We're not going to cover all 19 steps. What we are going to do is we're going to highlight some things that we think will be helpful to you when you are thinking about how to file and how taxes may factor in. So, line 1 here is where you would put your provisional income number. Provisional income is the number that is used by the IRS to determine how much of your Social Security benefit is going to become taxable. Provisional income consists of 3 items. Number 1, all of your income, your adjusted gross income. So capital gains, long and short, any wages that you have, 1099s, K1s, rental income, interest income, dividend income, everything that you have. Plus, okay, that one's not a surprise, but the other 2 kind of sting. The first plus is municipal bond interest income. So if you are a municipal bond person or someone who's bought some municipal bonds, you probably did that because you wanted to collect some tax-free interest. The problem is today that if you have some municipal bonds and you now are filing Social Security, your municipal bond interest income does count towards your provisional income number, which could cause Social Security to become taxable, so not quite as tax-free as we had hoped. Yes, the IRS does find a way to get at just about everything. Okay, last one. This one is the stinger. 50% of the Social Security benefits you're receiving count towards the number that determines how much tax you're going to owe on Social Security. So I've done this live enough to hear people shout out things like, hey, that's double dipping. So, if you're feeling that way, I kind of get it, I understand, but that is how it works. Now, if that number, if you're single and that number is above $25,000, you could be paying tax on up to 50% of your benefits. If that number goes above 34,000 single people, you could be paying tax on up to 85% of your benefits. Married couples, 32,000, you start paying taxes on your benefits. If you go above 44,000, you could be paying taxes on up to 85% of your benefits. So the magical question is, how much tax? Right, good question. How much tax? Well, unfortunately, this is where it gets a little complicated. So let's say you're cruising through retirement. Everything's going well. You've got some income from your investment accounts. You've got some Social Security coming in, and everything's going great, right? No problem. You're enjoying your retirement. You're having a good time. You're cruising along just fine. But, we've been cooped up for a while. Hopefully some of you have managed to go some places and enjoy things this year or this summer. And so that would be nice. But, you'd like to go on a nice trip, right? It's time to check off some bucket list items. You're feeling good. You want to go do some stuff. So you talk to a friend or a relative or somebody close and you say, hey, let's go do something. And they say, great, yeah, that sounds awesome. So you start booking your travel plans. And as you're getting stuff booked up, you accrue a nice little credit card bill, and that credit card bill works out to $10,000. No problem, right? You got some savings, you got a place to go get it. Maybe not just sitting around, but you have accounts, right? You've saved money for your retirement. So you survey your accounts, you got to get that $10,000, pay off that bill, so no problem. And you see, hey, I got my 401k. It's done well. It's grown nicely. I got a sizable amount there. What did I save all that money for? I saved it for me. So I'll pull the money out there and pay off that credit card bill. So you call up your 401k plan. Say, hi, I'd like to pull $10,000, please. They say, no problem. And then they ask you a very important question. How much tax would you like to have withheld from this distribution? Oh, yeah, taxes, right, yeah, of course. Maybe you already know or you have to go look, but you're in the 12% tax bracket. So you say, well, I'll withhold 12%. No problem. They send you your money. You pay for your trip. You go on your trip. Everything's great. You enjoy it. And then next year comes around and you are in March and you're punching things into TurboTax or H&R Block or whatever you use, okay? So you're punching stuff in, right? Getting it all done. Or you send it all to your accountant. and the accountant calls, or you are TurboTaxing and it says you owe money. What? I never owe money. I always withhold enough tax. Something's broken. What's the problem? Well, here's what happened. Unfortunately, TurboTax is not broken. Your accountant is doing a good job. You didn't withhold enough tax from that distribution. When you pulled that $10,000 from your 401k plan, you were in the 12% tax bracket. You were correct to withhold 12%, but what you didn't realize is that you were above these limits. And so when you took that distribution, you caused $10,000 of your Social Security benefit to become taxable. $10,000 at 12% here plus $10,000 at 12% here, you should have withheld 24%. You didn't get more money from Social Security, you just caused it to become taxable. This, although annoying, is not the bad one. The bad one works like this. Let's say you've done a lot of smart things in your life, or you've saved up some dollars, right? You put the money in the 401k plans. You got your employer matches. You took the money back from the IRS that they were going to tax you on. You grew this nice account. You saved and you saved so that you could retire and retire successfully. You get to retirement. You have some plans. You're going to pull a little income, but you're not going to pull too much because you've done the next smart thing. You got your expenses down. Okay, I know this because I talk to many of you, and many of you do this. You get your expenses down. You pay off the car, you get rid of the mortgage, you get rid of that co-signed student loan with your kids, or whatever it is that you have, right? You get all these expenses down. You downgrade from cable to Netflix, or you go down to one vehicle. I mean, we've seen it all, right? Okay, but you do the things to get that spending down, because what do you want to make sure of? You want to make sure that you can get through retirement, enjoy it, have a good time, really have those golden years that we all talk about, but you also do not want to be a burden to your family. You don't want to get towards the end of life and have some major medical event that you can't pay for. You got to ask for help. So get your spending down. But here's the byproduct. Your accounts continue to grow. That 401k plan keeps growing. And then one day you wake up and you've turned the age of 72. At 72, you have now what is known as a required minimum distribution. Required minimum distributions apply when you reach the age of 72, and you have any IRA, 401k, 403b, 457, TIAs, TSPs, any of these tax qualified accounts. If you have an account like that, you must pull from those accounts. You don't have a choice. If you pull from those accounts, you are above these limits, and that account has grown very sizably. That means that distribution could be quite large. You cause additional taxes to happen over here, and now, whoops, it's not 12 and 12 is 24 anymore. It's the 22 and 22 is 44. These are the kinds of tax mistakes that we find very important to help our clients pre-plan for. We urge you to do the important pre-planning to make sure that you avoid that type of an event. Unfortunately, we see many people head in that direction, unfortunately with no real insight that that could happen. Okay, let's look at a case study that kind of highlights how this works. So clients are 64 and 62. We're going to highlight this tax interplay and Social Security interplay and how it works with your overall retirement income picture. And we're going to highlight why Social Security is so important to so many folks in terms of optimizing a retirement income plan. Clients are 64 and 62. Between the two of them, if they file for benefits early, they have $34,000 in Social Security. They're going to start their retirement with $752,000 in 401k and IRA assets. They're going to be able to earn 6% on those investment accounts, and they'll need to increase their spending of $70,000 per year by 3% to keep up with inflation. They will live to 86 and 89 respectively. If this couple files for Social Security early, what you will see here is that Social Security is covering about half of their total income need. The rest of their income is coming out of their 401k and IRA accounts. The red line is the income line that they need to hit to keep up with inflation, and the amount of the orange lines above the red line is the amount that they're subject to paying in taxes. For some of you who heard this example, you said $752,000. That's pretty close. Okay, it's a little off maybe, but close to me. 34,000 Social Security. Yeah, so it's in the neighborhood. All right, fine. Our age is similar. And so this example is going to be quite pertinent. For some of you, you heard that and said 752,000. What happened? Didn't they have any kids? So look, in this example, what you're seeing here is when they file Social Security early, because of all the pressure they put on their portfolio and the excess taxes that are being paid, you notice those taxes are increasing exponentially, not linearly. That's because of that double taxation process. By filing Social Security in a non-optimized way, unfortunately, they run out of money 14 years too soon. Now, if you're looking at this example and you said, I knew that was going to happen, Kyle. I knew that you were going to run out of money. They didn't save enough. They didn't work enough. They got to keep working. Well, actually, they don't necessarily need to keep working, but this couple has a tax problem with only $752,000. So the difference between this slide and the next slide is only a change in the Social Security filing strategy. We are only changing that because we want you to understand how important the Social Security decision that you make really is and how it's not in a vacuum. You have to factor in how your taxes are going to play in. You have to factor in how your investments are going to play in. You got to factor in your portfolio longevity and your longevity. All of these things have to be taken into account in order to make the highest quality Social Security filing decision that you can. And why wouldn't you want to do that? So here's the key. This slide to the next slide is only a change in the Social Security filing strategy, and you'll see a couple of things. Number one, portfolio lasts the rest of their life. You see, what they're going to do in the early years is they're going to get all their income out of their 401k accounts. Puts a sizable amount of pressure on their portfolio. We might feel uncomfortable with that, but once they trigger Social Security, look at how much more of their total income need is covered, drastically taking pressure off the portfolio thereafter. And I don't know if you can see this, little orange lines above the red line, but not too much. Okay? It is not uncommon when we do pre-planning for folks to get them in a position that once they file for those Social Security benefits, they could be paying very little and sometimes even no taxes. We're not implementing any advanced tax planning here, no Roth conversion strategies, no restructuring of investment accounts, none of that stuff. But if we did, very likely this couple could be paying zero taxes. Portfolio lasts the rest of their life. If we compare the taxes side by side, the optimized Social Security plan is the blue lines. Taxes are a little higher early, but in the long run, they pay way less in taxes. All these orange lines above the blue lines are all the excess taxes that are being paid simply for filing Social Security in a non-optimized way versus an optimized way. Now, eventually, on the non-optimized plan, they stop paying taxes, but they're broke, so it's not a good deal. This couple, by optimizing Social Security, gets three major benefits. Number one, they get $186,000 more out of their Social Security benefits. Two, their portfolio lasts 14 more years. Three, even though they weren't paying any taxes for 14 years in the non-optimized plan, they still save on taxes by optimizing their Social Security benefits by $35,000 over their lifetime. Okay. There on your Social Security statement, a couple of quick things. There are no cost of living adjustments applied to that statement. It is a snapshot in time. Your statement also assumes that you work all the way till 62, retire, file immediately. Or all the way till full retirement age, retire, file immediately. Or all the way until 70, retire, file immediately. It's your work history only, no spousal coordination, and then certainly and obviously no advice. So look, after hearing our presentation today, you may or may not feel that you could use a more individualized assessment of your specific Social Security filing strategies and planning needs. If you do feel that way, we have made arrangements for you to be able to receive a complimentary, free Social Security analysis. Now, we're going to talk about in just a minute how you can request a free workbook. You get the analysis for free if you would like that as well. And I don't think you paid anything to be here, so we've got too much free stuff, right? That's the problem. Okay, so if you're thinking and you're going, hey, wait a second, what gives? Well, let me just address that for a minute. So, well, they took them away again, but there was a short stint there for a few weeks where you could go to Costco, and Costco had samples. Okay, they used to have them, then COVID, and then they had them for a brief stint, and now no more. Thank you, Delta, the variant, not the airline. And so, so samples. Okay, why does Costco, which is a hideous place to go to, but the redeeming factor used to be on the weekends. I say it's a hideous place to go to because it gets so crowded on the weekends, which is typically when I go. And so, what's the redeeming factor? Well, they used to, or they would normally have samples. Why does Costco give away samples? Because they like giving away free stuff. No. They do the samples because their hope is that you try something that you weren't intending to buy, and you say, hey, wow, that's pretty good, and then you go ahead and make a purchase. The sample that always comes to mind for me was the grass-fed beef bratwurst. We buy them fairly regularly now because I tried it and I said, hey, that's pretty good. But it was a sample that caused me to say, wow, that's really not bad. I like that. And so we sort of feel that way about our analysis, okay? This analysis for your Social Security benefits, we believe, is a very good sample of the work and the value that we're able to provide to our clients in the realm of retirement planning. And so we believe that if you receive this analysis from us, there's a very good possibility that we may earn the right, or maybe I should say the privilege, or maybe I really should just say the honor, okay, of serving you with other planning, whether that's retirement planning or investment planning needs that you may have. And so that's why we do this. That's why we offer it at no cost for free. Now, if you think an analysis like this could be helpful to you, let me tell you a little bit about what's inside of it. So first of all, personalized strategies specific to you. It'll detail out for you. Here's when we think you should file. Here's the exact time. December of 2022, Mrs. is going to switch to the survival. Okay, you get the idea. Okay, detailed strategies, and we'll give you multiple options. We'll talk through the differences. We'll compare the differences. We'll look at a break-even analysis. What's the best way to file if this happens or that happens? Okay, all of this is included in this analysis for you. Now, the thing that sets our analysis apart, if you've ever received a Social Security analysis or done one of those free calculators, the thing that's going to cause you to go, wow, I'm so glad I got this. I'm really happy that I went ahead and took advantage of this analysis. The thing that sets ours apart is this right here, okay? This is a screen capture from our Retirement Defender software. This is a proprietary retirement planning tool specifically geared to help us do tax planning within the framework of retirement planning for our clients. And so we get to look in a very detailed way at how taxes is going to factor in to this Social Security decision and how it's going to factor in overall to your retirement plans and strategies. And so, for example, this is a part of the analysis here. Okay, on the request, when you're requesting the analysis, for those of you who are, it's called the Retirement Income Cash Flow and Tax Analysis portion. So if you select that, then that's what you'll get this part also. Okay, now one thing that's important when you're looking at a good cash flow analysis is you'll notice here that we're suggesting this couple do a $42,350 Roth conversion. Okay. Now, it is not uncommon for us to get down even into the pennies on this, and that's because with the IRS, frankly, you don't mess around. So you have to do very detailed planning, and that's what this analysis is going to do. We don't just give some general, you should probably do 30,000 or maybe 20,000. No. We get down right down to the dollars and cents the nitty-gritty of here's what it looks like you should be doing. Now we look forward into future years and we say, how does that help? Well, for this couple, doing these Roth conversions kept them from being taxed on the full 85% of their benefits for the rest of their life. Really good deal for them. Also, it was able to get them more dollars into Roth dollars. Roth dollars are completely tax-free, and so they have $700,000 more of tax-free monies, and so that's a big deal. It made a big difference to them. How will your numbers look? We don't know. We have to see, okay? So if you're going to request the analysis, I really encourage you to get this portion of it also, because it's the thing that really sets ours apart, and I think it'll be very helpful to you, okay? Okay, here's how you request the workbook and how you request the analysis. As soon as I'm done describing this, we're going to go right into the Q&A portion of our time together, okay? So if you have a question, go ahead and throw them in the chat, and we'll start answering them in just a minute. However, to request your workbook, you'll go to sendworkbook.com, sendworkbook.com. Same website, sendworkbook.com is what you leave the free analysis, okay? The workbook and analysis are both available at sendworkbook.com. You don't have to do both. You can do, if you're thinking, I just want the workbook for now, that's fine, okay? Yeah, it's no pressure from us, okay? We're very busy. We see lots of clients. We do these workshops weekly. We are working with lots of people. If it's not the right time for you, it's not like we're going to have our feelings hurt, okay? So we'd love to interact with you if you think that analysis is going to be helpful. We're honored to provide it to you, and we encourage you to take advantage of it. If you're going to take advantage of it, same website, you just a drop down that says, yes, I'd like to take advantage of that free analysis. If you need to coordinate with other retirement assets and or worry about taxes, one of those two boxes will get you that enhancement. Also, as you're going through that process, we do make available to you our proprietary retirement planning process, the screening report that is sort of the introduction to that. It will highlight for you and look at the 7 critical areas that we find are most likely to affect folks' retirement plans. And if you want to take advantage of that also, we encourage you. We're honored for you to do that. That is also at no charge, okay? Again, sendworkbook.com is where you go. A couple of quick disclosures about the analysis process. Number one, doesn't matter where you're located. We are able to interact with you over a video conference setting. All of our advisors are certified, trained by me, and fully licensed, okay? So they have all the appropriate licenses, including a fiduciary license. We do not have any of our advisors who are not fiduciaries. All of our advisors are fiduciary. It's a requirement. The fiduciary, of course, requiring by law that we act in your best interest. When you interact with us through this process, we have to treat you as a client. That means we treat you as a client in terms of the recommendations and honoring your best interest. It also means that in terms of your privacy, same thing, we have to treat you as though you're a client. So we have a very strict privacy policy that we adhere to that's right in line with state and federal laws, and we are not allowed to sell or give your information to anyone else. We have to treat you exactly how we treat our clients in that secured, encrypted fashion, which we do. Okay, video conference setting is how we deliver the analysis with you. We'll be on camera. Whether you're on camera or not is completely up to you, but we're happy to do that. If you get to the point where you are engaging with us beyond the analysis, our advisors will discuss and disclose to you way ahead of time any costs or fees that you would pay to work with us beyond the free stuff, okay? So 2 primary ways that our clients hire us. The first is they'll pay us hourly fees. Hourly fees depend on who the advisor you're working with, their skill level, expertise level, and experience level. So they'll disclose to you ahead of time what their fees would be if you decide to work with them beyond the analysis. Also, if you decide to work with them beyond the analysis, you don't have to pay hourly fees. You could also simply hire us to do investment management, and we work off of advisory fees if we go down that path. Our typical advisory fee is going to range between 0.5% to as much as 1.2%, and the average across our firm in terms of a client's total assets that we advise on is less than 1%. So We think that you'll find our fees to be very reasonable and something that you will be excited and happy to pay, and you'll get more than enough value out of that to feel wonderful about it, if I can say that. Okay, you can go to sendworkbook.com at any time. I'm going to start answering questions here. You can open a new browser tab, open another window, do it on your phone, whatever you want to do. I'll still be here answering questions. You can still hear them. It's no problem. But I do encourage you to go ahead and request your workbook and make sure you get that ball rolling, and then I'll start answering questions right now. Okay, let's see here. Savannah from YouTube says, so if I wait to full retirement age and I make over $50,000, I can still draw my Social Security. There's no limit on the amount of earnings. That's correct, Savannah. You heard it perfectly. Okay. Beth asks, is Social Security income taxable when you retire and are not working? Probably, well, it depends on your other sources of income, Beth. So if your only income is Social Security, then you're not going to pay taxes. But if you have any pension income or investment income or withdrawals out of 401ks or annuity income, if you have any other source of income, then you could start paying taxes. Okay, Jay is saying, Kyle, break even for Social Security. We both filed at full retirement age 66, and RMD will be here at 72. How does taxation come? You stated double taxation, a bit confusing. Yeah, so Jay, it's not for sure that it'll be double taxed, but there's a good chance. It depends on, what your income levels are at. If you're above the 44,000 or 32,000, if you're above the 32,000. Then you may be dealing with the double taxation unless your other sources of income are already high enough to push you to the full 85%. It is confusing, Jay. I'm sorry for that. But if you're getting the analysis, we'll be able to detail that out for you. If you're not, what you want to do some research on is a thing called the Social Security Tax Torpedo. Okay, Antonio says, we need more of these type of seminar meetings to build a maximum understanding of this. But one was a full symphony of sounding knowledge. Thanks. Well, I hope you're saying this one was. I like the idea that it's a symphony of knowledge. I like that. A symphony of knowledge. Maybe we'll change our ads for this workshop too. A symphony of knowledge of Social Security. I like the sound of that. Thanks, Antonio. All right. If you weren't talking about this one, then I guess I'll take the compliment anyway. All right. Katina Cobb says, what if you've been on Social Security disability? So it's Social Security disability simply will convert to regular Social Security once you reach your full retirement age. Natividad says, I'm not able to get in. Well, it's https://sendworkbook.com. Or if you want to put www.sendworkbook.com, you could do that also. Or you can click the link. There should be a link here that should be pinned to the chat that you can simply click. Okay, Deborah says, if not ready for the analysis and other reports at this time, can we request them at a later date? Of course not. No, I'm just kidding. Yes, of course you can. Okay, I must be feeling a little too vacation-y. All right, so yes, Deborah, that's fine. It's no problem. We'll be here. I mean, there's always the chance that we stop offering the analysis, I guess. I mean, we've offered it for some time now, and we intend to keep going, but there's always a chance that if you wait too long, we might not offer it anymore. But otherwise, yeah, it's no problem. Okay, James says, at what age can one go back to work without reducing Social Security benefit income? That'd be your full retirement age, James, full retirement age. Okay, Soft says, do you also do estate planning? So we do assist with estate planning, but we're not attorneys. We don't write your estate plan. Okay, now we deal with a law firm that is a national law firm, and they can write estate plans anywhere in the country. We do that obviously because we're all across the country, and so we do have the ability to help with that process, but our firm specifically is not an estate planning firm. Okay, Leslie says, this is the first Social Security workshop that thoroughly explained everything. Oh, thank you, Leslie, appreciate that. Also, only second time I have heard about Roth conversions. Okay, my full retirement, I'm going to be 60. Thinking I need to do conversions now, question mark. I can do that with Simple Plan. Yeah, so Leslie, great question. Probably you can do it with a Simple Plan. But there are participation timing rules, and technically you need to roll the simple into a traditional IRA before you do the conversion. Okay, but any good advisor should be able to help you navigate that pretty easily. Okay, but yes, Roth conversions can be a very helpful tool, especially since you're so young. You know, you have a chance to really get some good planning done, especially on today's tax code as well. We're in a favorable tax code now. Okay, Dan says, if you stop working at 62, but do not take Social Security until 67, and you have no employment after 62, how does that impact the amount of Social Security you receive at 67? Well, it depends on how many years of substantial earnings you had, what those levels were. It probably means that whatever your statement says is a touch higher than what you're actually going to get, but the difference will depend on how much in specific earnings that you have. If you want to know exactly, you want to provide you're getting the analysis, you want to provide your earnings history, the actual Social Security statement, to the advisor that you meet with, and that advisor will be able to do a very specified analysis using your earnings history, and that'll give you a very accurate picture of what you should be expecting, Dan. Okay, Janet says, can we get a replay of this video? It'll be up for up to 12 hours usually, so it will stay up for some time. Otherwise, we'll see you next week, Janet. Okay, what needs to be provided for the analysis? So the analysis is that initial meeting with one of our National Social Security Advisor certified professionals and fiduciaries is going to be an initial fact-gathering meeting. So we'll gather the information that's required to get the analysis together. Generally speaking, for that meeting, you want to be prepared with a Social Security statement, investment account statements, all the financial things that pertain to your specific circumstance. So any income streams that you have, any of that stuff. Sometimes it's helpful to have a tax return handy. Okay, it just depends on your specifics as to what documents are going to be meaningful for your analysis. Okay, Jeannie says, how does Social Security address unemployment? Unemployment is considered earned income, and so you have to be mindful of the earnings test. Commercial Campers, semi-retired, says, if my husband claims benefits off of my wages, does he get the same amount as me or 50%? 50%. I am going to be 63 and not currently working. Should I retire first since my spouse's income is higher, or wait to get a higher payout? I assume you mean file Social Security. I do have 401k and other income. Yeah, it depends on your situation, right? I mean, you could really benefit from some Roth conversions, maybe a delayed schedule. It also might make sense for you to file early and do Roth conversions. It just depends on the specifics of your overall planning needs. But if you're the lower wage earner, Doro, then there is a good chance that there's not going to be a great benefit to you delaying out as far as maybe your spouse might delay. Okay, Beth says I couldn't find the link. Okay, it's just sendworkbook.com. My staff, it looks like they replied and posted it right after that, so hopefully you found it there. Okay, Michael says, once collecting Social Security benefits, how is military retirement and disability adjusted? It's not, okay? It will not be adjusted. Or will you still keep this? Yes, Art. Yeah, you'll keep getting the same disability and retirement. That's right. Assuming that it's a military disability and military retirement. Okay, Nancy Helgeson says, if waiting to take Social Security until full retirement age, is the amount calculated by the month when I file? In other words, I'm 69 and 1 month. Do I get a little credit for my 1 month? The answer is yes, Nancy. Great question. Yep, you absolutely do. And Jody asks, maybe you're saying, how much do you suggest having in a traditional and then a Roth? Well, it depends on your planning needs, right? You need enough money saved to hit your retirement income plans and goals. So that's step one. Step two from there is then optimizing for an effective tax strategy. So in terms of how much, the more in Roth, the better. But, there again, it depends on your overall planning needs. The bigger and more primary issue is to get enough saved so that you can retire and hit your income goals. But then the second step would be to optimize your taxing. Okay, Helen asks, can you do a Roth conversion with a 457? It's a two-step process. So first you have to roll that 457 into a traditional IRA, and then you can convert the traditional IRA to a Roth. But no, you cannot go direct from a 457 to a Roth. Okay, Ann Henderson says, she's replying. She liked Helen Thompson's question. Okay, yep, so there you go, Ann. My answer doesn't change. Okay, Judy says, earnings test, is unemployment income added to your income calculation? Yes, Jeannie. Mash Brains, some of your names are kind of funny, I like them, says, does a taxable IRA to a Roth conversion add Social Security income to your base? No, only earned income do you pay FICA taxes on. So in order for you to pay FICA taxes, it has to be earned income. A Roth conversion would not help with that because it's not earned income, you don't pay FICA taxes on it. Same thing when you take a distribution from an IRA, or you have pension income or annuity income or interest income or dividend income. Any of those types of sources do not you don't pay FICA taxes on those dollars, so it doesn't help your income or your Social Security benefit. Okay, Deborah's asking, is your company familiar with the DROP program for Florida state workers? So, Deborah, if you want to work with someone who is for sure absolutely the right person to talk to about that, just make sure you let the person that you talk to for your analysis, your initial meeting, let them know that you want to work with Frank Endress. The first person you'll interact with for that fact gathering meeting is going to be one of our associates, again, fully licensed, certified. But if you're getting into that next step where we're delivering the analysis, taking a deeper dive, looking at taxes, all of that, you just want to ask for Frank Endress. Okay, so Frank Endress is the one to ask that can help you with that. Okay, Charlotte says, do you stop paying FICA when you reach full retirement age? No, you don't stop paying FICA. If you have earned income, you pay FICA. You could be 100 years old. If you have earned income, you pay FICA taxes. Okay, Al says, the Roth conversion is a free service you offer, correct? So the Roth the analysis of it, where we look at that with you and think through it with you, yes. In order for us to actually assist you with Roth conversion planning in actuality, where we calculate your taxes, give you the recommendation, help you actually convert the dollars, you have to be a client for that, okay? So if we're actually helping you with the process of doing the conversion, that is something we do for clients. We don't do that for free. But we will look at for free in the analysis the benefits of it. Is there a possibility that could really help you? Okay, Jennifer says, my mother has a Social Security right now of $1,079. She also receives an annuity in the amount of $306. Those two combined is more than $25,000 a year. Wait, 1,300. That's not more than 25,000. I don't know if it's more than 306 or maybe what, but that's not more than the 25,000. So I'm not sure. Am I doing my math right? Yeah. Yeah, so you're at 13,000 plus another, yeah, you're not even over 20. So I'm not sure. So she doesn't pay any taxes with those numbers, Jennifer. Unless you typed them wrong. Feel free to correct me. Okay, Jay signed up for the book and the analysis. Okay, great, Jay. You'll get a lot out of it. It's good. Okay, Jeannie says it costs to convert to Roth. Yes, you have to pay taxes on those conversions. If you're in the low tax bracket and 70 doesn't seem to be worth it. Maybe the opposite, Jeannie. It depends on how much you have an IRA, because once you hit 72, you have to pull from those accounts. So if doing Roth conversions now in a low tax bracket saves you from getting pushed into a higher tax bracket down the road, and we revert on the current tax code to the old tax code, which is not as good, then your Roth conversions now may be a wonderful idea. Now, you would never want to convert everything all at once. You need some kind of strategic plan to spread it out over a number of years. Okay, Katina Cobb says, on disability, when I reach 65, will I be able to draw off my husband? If he files for his benefits and 50% of his benefit is more than what you're getting, yes. Jay's asking, do you have any local presence in Texas? We don't have any advisors located in Texas, but we do have a lot of clients in Texas. Occasionally we go down there. Jill says, can I convert an inherited IRA to a Roth IRA? Yes. Yes, you can. Oh, no, I'm sorry. What am I saying? No, you can't. Hold on. Rewind. Can I convert an inherited IRA to a Roth? No, you cannot. You cannot do that. I must be getting tired. Maybe times for just a couple more questions because I'm kind of wearing down. Again, if you haven't already, go to sendworkbook.com, request your workbook, request your analysis, subscribe to our YouTube channel, follow our Facebook page. We'd love to interact with you at future workshops and events, and we'd love to see you. Okay. Janet says, can you explain again why you don't want to take the higher earning person at 62? Yeah, because the higher earning person is going to be the survivor benefit when one of you passes away. So if the higher wage earner files at 62, they may be sticking that surviving spouse with a lower Social Security benefit for the rest of their life. And if they happen to die early, that could really be painful. Okay, Art says, many thanks. Good. All right, good. Oh, great, Art. Yeah, thank you. I look forward to seeing you. Okay, Jeannie says, apologies. What I meant was, does the unemployment count as a year of your income and added to your 35 years of total high earnings? Yes, you pay FICA taxes on it, so the answer is yes. Okay. Paula says, during the analysis, do you look at any annuities? Yeah, if you have annuities, we certainly need to know about that because, you know, whether you have an income rider that you're thinking about triggering, that's going to affect your income and taxes and how that will play into Social Security. You know, if it doesn't have an income rider, you know, there could be investment earnings. If it's non-qualified, it'll generate different taxable income exposure than if it's an IRA or a Roth annuity. So yes, yeah, we would definitely, if you have annuities, you want to bring information about those to your analysis meeting. That'll be very helpful for you. Okay, requested the workbook now and we'll get the analysis. Good. All right, good, Debbie. Later, yeah. George says, is there a common mistake single people make when filing Social Security? Yeah, they think that it doesn't really matter and they don't really factor in taxes. Okay, you kind of go, well, I'll just do it whenever I'm ready and I want to and it feels good to me. Okay, no, really take seriously taxes. Okay, that's the big issue for single folks, and you need to be very cognizant of that. Single folks, you don't have that married filing tax code, which gives you a lot more income limits and room. Tax planning becomes very essential to you, especially as you age and maybe need to deal with medical expenses down the road and that sort of thing. Okay, Jimmy says, my ex-wife passed away 2 months ago at 59. Am I entitled to anything? Well, it depends on whether you filed for a benefit yet or not, Jimmy, and also what your age is. So you have to be over 60 to file widow benefits. And then do you have employment income? That's another factor. If you're going to get the analysis, we can think through all those details with you and figure it out. Okay. Thank you, Kathleen. Oh, Deborah loves North Michigan. Yeah, we're up in the Upper Peninsula. We're hanging out in Marquette, Michigan, which is a cool town. Lots of fun biking to do around town, and Lake Superior's just right over there, so it's a lot of fun. And we're going to go check out a lot of things up here in the Upper Peninsula. It's a nice little middle ground spot that has internet where I can still do this, and good houses that can be rented. And so we're staying in a house up here and hanging out for a few weeks, and then we'll head back down to the Detroit Metro. Okay, Al says, yes, I'm at Roth. Oh, okay, yes, okay, good. Thanks, Phil. Enjoy your vacation. Thanks, Al, appreciate that. Okay. All right, looks like we're wearing down on questions. Again, please do go to sendworkbook.com, and we look forward to interacting with you. If you are getting the analysis, we're excited for that. We're honored to provide it to you. Sendworkbook.com, request your workbook. Again, it's a physical copy. We're going to mail it to you, and the analysis can be requested right there on the same website. So again, that's at sendworkbook.com. Follow our Facebook page, subscribe to our YouTube channel. We'd love to interact with you at future events and talk with you more. And with that, we'll wrap up for tonight. Appreciate all the questions, great questions, and we'll look forward to seeing you.